So most people enter financial markets with one goal, profit. But professionals enter with a different goal, survival. Man, that is the harsh, unspoken truth of the financial world. If you're stepping into the markets expecting to just get rich quick, you're kind of already walking into a trap. Today, we're going to completely shatter that illusion. Because before we can even begin to talk about making a profit, our ultimate, absolute goal today is purely survival.
Welcome to this explainer. I am absolutely thrilled you're here with us because what we're covering today, it's not your standard run-of-the-mill finance tutorial. Not at all. Think of this as your essential emergency survival briefing for the financial markets. Whether you're looking at crypto, Forex, stocks, the whole shebang, the principles we're about to cover are universal. Simply put, if you protect your capital, you protect your future.
Okay, let's dive into this and briefly walk through the survival kit we're going to unpack today to keep your money safe. We'll start with survival before profit, then move into protecting your trading capital, followed by your financial safety net. After that, it's smart asset diversification, mastering your trading emotions, and finally, navigating highly volatile markets. Let's jump right in. Section 1, Survival Before Profit, the mindset shift. When you enter the financial markets, you need to realize you are stepping onto a battlefield. The market honestly doesn't care about your hopes or your dreams. It moves based on global events, supply, demand, and raw human emotion. You literally cannot remove risk from this battlefield. Risk just means the possibility that you might lose money because the future is entirely uncertain. But while you can't remove it, you absolutely can control it. And that knowledge, that is your armor. So, what's the single biggest difference between an amateur and a pro? Well, it boils down to just one question. Amateurs are completely obsessed with the upside. They enter a trade and immediately ask, how much can I make? But a professional knows that survival matters way more than strategy. A professional looks at that exact same opportunity and asks, how much can I lose if I'm wrong? That tiny little mindset shift is exactly what separates the rookies who blow up their accounts in a week from the veterans who stay in the game for decades. Always, always think about loss before profit. Which brings us to Section 2, protecting your trading capital, controlling the leaks. Now, what's really interesting about this slide is this tiny percentage, 1 to 5%. This right here is the golden rule of survival, the most important rule we'll talk about today. If there's one thing that separates the survivors from those who lose everything, it's that you never, ever risk money you cannot afford to lose. Practically speaking, that means never risking more than 1 to 5% of your total capital on any single trade. It sounds incredibly small, right? But let me show you why this is your absolute superpower. Let's actually look at the math for a second. Using a 200,000 Naira account as an example, if you apply a strict 1% risk, a losing trade only costs you 2,000 Naira. Even at a 5% risk, the max you lose is 10,000 Naira. Think about what this means logically. You could literally be wrong 10 times in a row, and you would still have the vast majority of your money perfectly intact. You easily survive to trade another day. Small risk equals long survival, and long survival equals a whole lot more opportunities. Think of your trading capital like a massive water tank. The water is your money. Small 1% losses, they're just like tiny controlled leaks. Your tank can easily survive them, and you have plenty of time to patch them up and refill the tank with winning trades. But what most unprepared traders do is they fall straight into the blow-up trap. They get overconfident, they ignore the rules, and they risk 50 or 70% on one sure thing. They blow a massive hole right in the side of the tank. One emotional risk, and the tank empties instantly. And once your account is blown, you are out of the game entirely. Capital protection is all about keeping that tank intact.
All right, Section 3, your financial safety net, the stop loss.
Let me introduce you to the stop loss. Listen, even if you have years of experience, you must fiercely respect this tool. A stop loss is simply a safety instruction you give the market. It tells the exchange, hey, if I'm wrong, close this trade and protect my money. Think of it exactly like a seatbelt in a car. You never get into a car hoping you'll need the seatbelt, right? But you wear it because if things crash, it literally saves your life. Well, a stop loss saves your financial life. And this brilliantly illustrates exactly how that seatbelt deploys in real time. Step 1, you buy a coin at 1,000 Naira. Step 2, immediately, not later, not tomorrow, right then, you set your stop loss at 950 Naira. Step 3, the market moves against you and the price drops to 950. Step 4, the trade automatically closes. Yes, you took a small, planned loss, but you protected your capital. Without that stop loss, undisciplined traders will just sit there staring at the screen, watching the price drop to 800, then 600, just hoping it comes back up. Professionals do not rely on hope. They rely on stop losses.
Moving on to Section 4, Smart Asset Diversification. Don't put all your eggs in one basket. We've all heard the ancient wisdom. Don't put all your eggs in one basket. If you dump all your money into one single coin and it crashes, well, you lose everything. Instead, a strictly balanced portfolio allows for true survival. When you build a smart crypto portfolio, you want to include large-cap, safer coins like Bitcoin and Ethereum. But you also need to hold stable coins to protect your overall value during sudden crashes. Plus, a dedicated cash reserve so you're actually ready to pounce on new opportunities. This balance ensures that if one asset drops, the others act as an anchor. But please, whatever you do, do not confuse smart diversification with random diversification. A massive mistake amateurs make is thinking they need to invest in absolutely everything. Buying 40 different dog-themed meme coins based on internet hype isn't diversification. That is just pure confusion. Smart diversification is intentional. It means holding a few strong assets that you actually understand, which allows you to clearly and effectively control your risk.
This takes us to Section 5, Mastering Your Trading Emotions, the Psychology of Survival. Because look, you can have the absolute best strategy, the perfect entry point, and the smartest diversification in the world. But if you can't control your emotions, you will still lose your money. The market doesn't destroy beginners. Beginners destroy themselves by letting 3 emotional enemies take the wheel. First is fear, which makes you panic and exit perfectly good trades way too early. Second is greed, which makes you risk too much and refuse to take profits because you just always want more. And third, the absolute deadliest of them all, revenge trading. That's when you take a loss, get incredibly angry, and immediately jump right back into the market just to quote-unquote win it back. Let's move to and see how this builds into the exact psychological cycle that wipes out everyday traders. I guarantee this timeline is going to sound painfully familiar to someone listening. Day 1, you make a small profit. It feels great, right? Day 2, that profit mutates into overconfidence. You think you've finally cracked the code. So on day 3, you completely ignore your position sizing and take a massive, heavy risk. Day 4, the market turns and you take a devastating loss. And instead of stepping away to breathe, day 5 hits. You're angry, you're desperate, and you start revenge trading. That cycle repeats until your account hits 0. The only way to break it is absolute, unwavering discipline to your plan.
Finally, Section 6, Navigating Highly Volatile Markets, the Ocean of Crypto.
You know, one of the absolute scariest words for amateurs is volatility, basically how violently prices jump up and down. But listen to me, volatility is not your enemy. Think of a highly volatile market like really fast-moving traffic. Moving traffic is exactly where the opportunity is. You can't get anywhere if all the cars are parked, right? A professional is like a highly trained driver. They know exactly when to merge, when to brake, and they use that speed to their advantage. An untrained trader sees those fast cars, absolutely panics, makes a sudden emotional turn, and crashes financially. Volatility equals opportunity, but for sure, only if you are prepared. And honestly, the absolute quickest way to crash in a volatile market is falling straight into the FOMO trap, the fear of missing out. This is when a coin is pumping, everyone on social media is screaming about it, and you rush in blindly just so you don't miss the boat. By the time the hype is that loud, my friend, you are already buying late. The price inevitably drops and you panic sell. Contrast that with the smart investor. They completely ignore the noise. They wait for the calm moments, they enter with a small, calculated risk, and they take their profits step by step on the way up. They don't rush, they calculate. Which leaves us with this final, incredibly powerful thought to walk away with. The goal is not just to make money. The goal is to stay long enough to keep making it. The financial markets are not some casino designed to make you rich by next Tuesday. They are a deeply complex ecosystem designed to reward discipline, patience, and strict risk control. You do not need to win every trade. You just need to manage your risk, protect your capital, and survive long enough to let your wealth actually grow. So I'll leave you with this. Are you trading today just to get rich by tomorrow? Or are you managing your risks so you can stay wealthy forever?